Happy New Year, guys. Happy 2019. Welcome to what I think could be one of the most volatile years of this bull market. We'll find out later on this year. Dan and I will be talking at the end, answering your questions. Hope that the material you're going to see, and this is going to be a full hour of material, but we've got plenty of time for questions after that. It's a tricky time. It's a tricky time in the market. We've got a full agenda. 2018, the year of the surprise. A lot of surprises. And then CB3 on 3, political, fundamental, technical. Those of you that have watched my videos or been reading the newsletters know that my new methodology for the last 2 years is to break down every single market action into one of these three or a combination of either political, fundamental, or technical influences. We'll then look at 2019, and then I'm bringing this back. I've done this twice since 2008, but whenever the markets get a little crazy, people will call or shoot me an email and say, tell me again, Charlie, why can't you just sell when the market goes down, wait, and then buy when it goes back up? And that's a fair question, and I'm actually going to address that. It's one that we would all love to be able to do, but it's not that simple. And then a Q&A after that. So, 2018, the year of the surprise. I can tell you from experience that portfolio managers do not like surprises, but I've had my share of them in this life. Those of you that have been here since the beginning, and I see a few of you out there, have heard this story before, but most of you have not. This actually happened to me a few years ago in Florida. I was in Florida seeing a client in 3 or 4 in the afternoon, and they recommended that I go see a friend of theirs. And I said, well, I've got a flight at 7. Well, you really want to go see this friend? And I did. And then I had to take a red eye back. So I called Alice and said, look, can you book me on a red eye? So she did. I get there. I'm in the last row of the plane, dead tired. And I sit down, and before we take off, the flight attendant comes back to me and puts a Coke in front of me and says, you look really worn out. Here, have a Coke. Which was a surprise because they never serve you before they take off. Shortly after we took off, she came back again. I wasn't sitting in first class, and she brought one of those little tiny bowls of almonds or whatever the nuts are, or cashews. I said, thank you. And she smiled and went back. That was a surprise. As we got into the flight, and I clearly was batting my eyes from being tired, she brought a blanket back to me. And actually kind of, not too much in my space, but kind of put it there and positioned it there. That should help you sleep on the way home. You look really tired. Thank you so much. Thank you. What a surprise. And so as the plane was landing, the 20 minutes where they say everybody getting there, she came back and says, everything just the way you wanted? Anything else I can do? No, this has just been wonderful. What a surprising red-eye trip you gave me. Could I just ask you one question? She said, and I said, sure, why not? Are you married? And I said, well, yes, I am. Oh, okay. That was a surprise. So everybody got off. I'm the last one. Remember, there's no one else in my row. And at the very end of the line, I'm there. And I shook her hand. I grabbed both hands and said, thank you for making this such a wonderful trip home. Red eyes are the pits, but you surprised me with that. And I turned a step away, and I stepped back and said, I have to ask this. Why did you ask me if I was married? I was looking for a really good answer here. And what she said was, if you had not been married, you would have been absolutely perfect. From my mother. From my mother. And that was a surprise. Now, it would be good if my Florida surprises ended there, but they don't. So some of you that were at the August Fireside Chat might remember that I went to my 45th high school reunion. I'm not going to show you pictures from that again. If you weren't here, too bad. You don't have to look at those pictures. But what I didn't mention at the time was that I met a guy whose name I can't mention that works for the Florida Board of Elections. And I guess it's a pretty high finagled job. He's still working because he's not a federal employee. And he told me that he counts balance and makes sure his names sync up and keeps things even and legal. But I said, can you ever find out how people vote? And he said, yeah, we for sure can. I can't tell you how we do it, but we can. So I really forgot all about that until after this election. Now, there were hotly contested races in Florida, right? So he called me a week or so after the election and said, you're not going to believe this, but I found out how your parents voted. You did? He said, yeah, they voted Republican. I said, there's no way. No, isn't your dad's name the same as yours, Charles Brown? And your mom's name's Jean? Yeah. There's no way they voted Republican. There's not a chance. He said, I'm sure they did. And I said to him, there is no way my parents would ever have voted Republican when they were alive. They wouldn't have done it. And that was a surprise. All right, let's get to it. 2018. The year started with a bang. Unfortunately for most investors, drew to an end with a gut-wrenching December. Now, that's the surprise of the year because December is traditionally one of the two best months of the year, November and December, sometimes January, as the major indices suffered a huge reversal, which was entirely out of character for a bull market. So in late September, the S&P 500 was up about 9% for the year, but it ended down 6.2% with 6 of the 11 sectors. So the S&P 500 is made up of 11 sectors: consumer discretionary, staples, utilities, energy, et cetera, et cetera. And more than half of them were down in double digits. So what does that mean? It means the ones that were not down double digits pulled the other ones back to make the S&P index only a 6% loss. Small caps had a much larger loss, and we'll talk about that when we go forward here. So it was thus the first down year on a total return basis in 10 years, or the first down year on a total return basis in the whole bull market. That sets it aside. The worst Christmas Eve decline in history. The market low was set on a closing basis on Christmas Eve this year. It's even more noteworthy because it's usually the second slowest day after the Friday after Thanksgiving in trading volume, and it's only a half a day session. So had they been going on longer than that, it could have been even worse. Now, that set the stage, though, for the December 6th largest daily turnaround in market history, from being down 611 points to a reversal in 90 minutes of up 260. The biggest single move in market history in that time frame, in 90 minutes, okay? So, for the first time since, 2009, longest bull market in history, all 4 major indices were down, and that's what they were down. 4% roughly, 5.5%, 6%, and the Russell 12%. So when you see small caps down this far, that's not a good sign, and I'm going to address that in just a little bit. Don't worry about the numbers on here, just look at the lines. When the lines go up and you see the 2 up there, that means that's a 2% day. We had 4 of those, but we had a lot more than that, 10 or 11 down days. One of them back in January was actually a minus 4% day. So even in December, we didn't hit that bad. What's the point here is that the market gained or lost 2% 16 days last year, which makes it the most volatile year in 7 years. So if you felt seasick, that's why you felt seasick, okay? I want to go back to talk about small caps. We use IWM, which is an ETF, to measure what's happening in small caps. They hit their high at the very end of August. The rest of the market didn't hit their yearly highs until September, and actually early October. And at one point, the small cap space was down 27%, the sharpest correction since the financial crisis. That's a 10-year look back. The speed and severity of this drawdown needs to be placed in a perspective, though. So if you go back 40 years, there have been 5 previous drawdowns that are this deep. But what does that mean? Well, it meant that these are actually buying opportunities, and we have data to show you here. And this is what it looks like. So let's look back to 87. The 79-day return in this window was down 33%. A year later, small caps were up 34%. 3 years later, 9%, 78%. 10 years later, 780%. So one of the things I want to impress on you tonight is recency bias. Just because December was so horrific, and December is normally great, doesn't mean you should think that that is going to set the trajectory for the next year in the market. This is actual hard data. This is the analytical side that I talked about in the video, not the artistic side, but the analytical side. All right, look at these drawdowns, 98, 90, 2002, and look at the recovery. Okay, that's what happens. So then the next question I get is, what's the recessionary risk? What is the recessionary risk? Non-recessionary bear markets are rare and not much worse than where we were on December 24th. A non-recessionary bear market means a bear market that happens when there's not a recession, okay? We're not in a recession. We're not even close to a recession. I'll have tons of data going forward to show you that. The only time this has happened I'm sure you know. 1987, when it literally dropped 20% in one day. Okay, 20% in one day. The S&P did come close. 78, 98, 2011, you remember that? It was like 19.9. And then just Christmas Eve, it was 19.8 in the S&P 500. So it almost crossed into bear market territory, but it didn't do it. Here's my take, we're not even close to a recession. Without a recession, the chances of a significant bear market happening are very, very rare. How many times has it happened? You saw it, 1987. Let's look now at the political influences, fundamental and technical. We're going to look backwards as to what caused what happened in 2018, and we'll look forward into what could happen in 19. These are the key factors politically for me. Obviously, the Trump-Xi Jinping relationship, China tariffs, the new trade deal with Canada and Mexico, although that's quieted down. Mainly, it's everything on this screen, even Kim Jong-un has been out of the news now for half a year. The tax situation, I love that sign. Now leaving Illinois too soon? Was it something we taxed? I mean, all the big states are losing population by the thousands because the state income tax. So that pretty much sums it up except for one big topic. Trade, tariffs, Trump, taxes. What one big topic did I not mention? The wall. You know, Pink Floyd should be coming out with something and piggybacking on this. Don't you think? Has anybody wondered that? Okay, now far be it from me to ever poke fun at a politician. You guys have been coming to these for over a decade. By the way, the 11 at the top means we're in the 11th year. Thank you all. Some of you, it's new to you. Some of you have been here forever. Okay, and we really appreciate that. So as you know, I would not pick on a politician. So what I did is I asked some of my friends on the left to provide a cartoon to support this. And this is what they gave me. Trumpty Dumpty sat on a wall. Now this is a really, really great wall. I'm just going to hop down and take this invoice to the Mexican president. I mean, it's kind of hard to believe he's saying that, but he is. Now on the other side, we have these two. Now, this is a pretty sober-looking pair. And I would love to have provided this, but I actually went to a friend on the right and said, what would you do if you were satirizing this? What does this speak to you? And he said to me, well, I think that they've got a side hustle going on, and GlaxoSmithKline hired them, and they're now the poster children. I don't know if that's true, but guess what he sent me, okay? Seriously, though, we are in the 26th day of the shutdown. It's a record setter, and it looks like nothing is going to change. And I have a son-in-law who's furloughed and not working in the State Department, so they're not happy campers. Here's as far as, that's politically, but as far as us making decisions as your money manager, part of the people that are not working are those that are generating these reports: wholesale trade, retail sales, business inventories, durable goods, housing starts, new home sales, all really important data. So what's happening? All this data is getting stockpiled, and someday when we go back to work, it's probably all going to be released at one time. So when the market just absolutely goes insane in one day, like the day that in 2011, the summer of 2011, when S&P downgraded the U.S., you remember the 4% moves up and down? We could be processing 3 or 4 months worth of data in one shot. So that's the risk we have. I'm making you guys aware of this, all right? So without a doubt, the immigration situation, I mean, you can say there's not an exact financial tie into this, but the reality is we have a dysfunctional government. And if they can't figure this out, we are going to have dysfunction and acrimony for 2 more years, which means anything that the Republicans, even though they've gained seats in the Senate and the president want to put on the table as far as economic growth, is not going to pass. It's going to be an absolute stalemate. And that's just something that's a political influence on the whole year. It's an oversight on the whole year. Now, many people say to me, well, China, this whole situation, we're going to lose. I take the exact opposite position. They are in a bear market. They need us far more than we need them. And in fact, it's my assessment that it's right here on this chart. Let me see if my red dot's working. See that number? That is what China, that's their surplus, that's our deficit. Okay? This is how much we are depending on them for them to buy our goods. This is how much they're depending on us to buy their goods. The Chinese are an exporter economy. Over 50% of their GDP are exports. About 17% of the U.S. relies on exports. We are a self-sustaining economy. So they have lost this. I think they've miscalculated. Time is not on their side. The longer this goes on, the worse it is for the Chinese economy. Xi Jinping thought if he waited a bit, Trump would come in and they would buy more soybeans and we'd be placated, because that's one of the first items where the Chinese picked up their importing or exporting from us to them. And then we'd claim a victory, but that's not happened. Whether you like the president or not, he wants more than that. He does not want to sustain a third of $1 trillion trade deficit. He just doesn't, right or wrong. And I know the Chinese people want to think long term, but the reality is they can do about all they want as their market tanks. And that's where they are right now. Fundamental influences, this is the data. So politics is probably been the most overarching influence on the market, actually second to technical. We'll get to that in just a second. Fundamental influences, jobs, retail sales, consumer confidence, consumer spending, the impact of the tariffs, which is different than the political actual tariff itself. How does this work? Well, so let's look at just some data here. U.S. building permits, U.S. vehicle sales, both of those charts should tell you a direction is what? The direction's up. Is it at the peak of either building permits or vehicle sales? No, it's not. It's slowing. But slowing doesn't mean it's reverting to zero and going negative. Okay, it's okay for things to slow down and not overheat. It would be great if every time I showed you this chart, because building permits represents the largest discretionary income most people have for their homes. The second largest are cars. So these two datum are the most important ones we look at. They're positive, albeit down from their peak. Doesn't concern me. Okay? Same thing here. Housing, biggest indicator. Perhaps something could be receding. If you look here at construction year over year, we're still positive. It's just we're obviously down from back in 2013, 2014. But we're not negative. Nothing wrong with the economy not overheating. An advantage to that is it keeps the Fed from continuing to tighten. I'll get to the Fed in just a little bit here. Housing is slowed but remains positive. Now, don't let this chart freak you out. I have to look at everything on here, but the only line you care about is the purple one, okay? So this is a very complicated index cycle, business index cycle, but the reason that I find it useful is it's been accurate for the last 7 recessions. So when you see these purple lines diving here, below this, we've had a recession. I mean, it's just right there. Here's where we are right now. I'm going to flip to the next chart so you can see where this enters the danger space. We're way up here. This is where this red line is where it would enter. This is the data, folks. I realize when you watch the news, they're saying, well, we think this, or this, or this. But this is data that's proven reliable, not just for me, but for many other people that do this for a living. This is the analytical side, not the artistry side. You can't argue with the data. We are not near a recession. And what are the chances of having a bear market without a recession? How many times has it happened? If you've learned tonight, once. Okay, good. Payroll, the most important data that comes out during the month. You've heard me say this for 11 years now. Non-farm payrolls. So we're going to dig into this. December's number, by any definition, was a blockbuster. The pessimists were dealt a huge blow, in my opinion, that just blew away expectations. So this bar way over here is what jumped up out of the congestion here and really looked good. So how good was it? 312,000 new jobs were at Briefing.com, which is one of the most reliable sources in the industry. They've been doing this for almost 40 years. Their expectation was 180. Now, that's an average of 254,000, 250,000 jobs every month looking back over the year. That is growth. The November, this is something you may not know, November payrolls revised up from 170 to 176 for 155, and non-farm payrolls revised in October from 237 to 274. Let me slow down and just say, when you get a piece of data, the government goes back and revises it twice. So when you hear GDP come out for December, which will come out in a week and a half, they're going to go into February and March and revise it once they get all their data. They want to get that first number out so traders can act on it. But it's not written in stone until the second revision. That applies to employment and GDP, the two most, I think, crucial pieces of data. These revisions, continuing to revise up, especially going back to October, is very positive. The private sector, 301,000 versus 175. Again, November and October revised upward. You hate it when they're revised downward. It does happen, but that's not what we're seeing. The unemployment rate, sure, rose 0.2%. What does that mean? People that were sitting out, the underemployed or the unemployed who don't get counted, decided to come back into the workforce, so naturally that's going to tick up. I think that could easily be absorbed, and the next report we see will probably be 3.8, maybe down to 3.7 again. The average work week increased. That means companies are hiring, and even though it's just a tiny bit, over millions of workers, that's a significant number. The key takeaway for me is that the data is unlikely to deter the Fed from its tightening path for now. My radical prediction is that by the autumn of this year, you're going to see the first interest rate cut. We will see an end to the raising of interest rates, and the first cut will happen in this year. And that's a great thing. So the deficit, we always have to talk about the deficit. People are concerned about the deficit. And so the last time there was a balanced budget, 2001 under Bill Clinton. He did have the Republicans in the House and the Senate to help him. Clinton was a pretty conservative guy. It's hard to look back and think that, but it's true. He got it done. And Bush, the year after 9/11, amazingly, this area right here, balanced budgets. They're the only ones since Andrew Jackson in 1837. I know, crazy. All right, so again, I'm trying to give you information that you can take back with you that'll, I hope, convince you that we're in a pretty good place right now. And here's one of them. I hear from people that, when the earnings peak out, we're going to have a recession the next week. So let's say a company earns 1.5%, 2.5%, 3%, 3.25%, 3 3/4, and then they tick down to 3 3/8% return, whatever. Oh, earnings have peaked. It's going down. Okay, here's the hard data. Let's look at 1953. So I've been alive for all of these except this one right here. So the peak earnings growth was in September of 53. The next recession did not start for 4 years. Not 4 months, 4 years. Looking here at 81, we remember this time frame. It took almost a decade. And during that time, the S&P gained 200%. Do you want to just jump out of the market because earnings have peaked? This is the data. Don't listen to the hysteria. They're selling you the hysteria in the news because they want you to watch and listen to them. This is the hard data. 95, 2001, 2000. Now this is only 9 months, but still, okay, that was an exception. That was a huge one. We don't know what's going to happen here. The point being that just because earnings may have peaked or seem they have peaked does not mean a recession starts the next month or the next year. So how much can we earn in the S&P based on GDP? A lot of people will say, well, you have to have a really high GDP to make a great return in the market. So let's look back at 1949 to 53. GDP, which is hard to even, that's like China's GDP. 7.1%. I wasn't alive then. Maybe some of you guys can tell me about this, but that's just a crazy number. And the S&P returned 21%. Okay, but we're at 2.3, and we still had a 15.2, not last year, but the year before. So it's looking like this economy has pulled those two numbers apart, and that it is possible to have strong S&P growth without tremendous GDP. And candidly, no one's really sure why. So understanding that data can support your argument or be contrary to it, it's also important to understand that data can contradict itself, seemingly, but that's actually what happened. So this is what we peruse to try to make good buying and selling decisions for you. One of the most important, I don't know if it's important, I think it's important, but the yield curve, okay? The yield curve. If you're going to put money in a fixed income investment, and you're going to tie it up for 30 years, you need a higher return than if you put it in for 2 years. I've used this example before. It's like your 16-year-old just got a license, and they want to borrow, like you're lending, the keys to them to go to the store to bring food back for the picnic. That's a short-term risk, okay? But if they come to you and say, well, some friends are going into Chicago, and I think we might be staying overnight, that's a longer-term risk. You're going to want more of a return, or you're going to protect yourself against that risk. The way that you do that in the market is to get a higher return. So the black line is showing starting at the 1 year to the 30 year. That is what's called a healthy yield curve. This is an unhealthy yield curve, although it is still positive, meaning you still get more of an interest rate return for the longer end. So when this starts flipping, what happens is fixed income becomes more interesting than equities. Because if you can get a 4 to 4.5% return with no risk in a treasury bond, what are you going to do? A lot of people are going to pull their money out of equities and go into bonds. We are not there yet. I think in December, a lot of people just pell-melled into that emotionally, and that's why you saw these huge days in what is one of the least volatile months of the year. So let's talk about the inverted yield curve. So this is not inverted, but if that red were down at 2.5, it would be inverted. So inverted means that the front end of the yield is actually paying more than the back end, and that usually means fear. Okay, flattening yield curve indicates weak economic growth, and the spread between the 2 and the 10, I actually showed you the 1, but the 2 and the 10 is the most closely followed on Wall Street. Because as you can imagine, Wall Street sells stocks. And if they see an indication that people are going to be pulling money out of the stock market and putting it in the bond market, they need to know that as soon as possible. So last year, the yield on the 10-year, which again moves inversely from the price, so when price is up, yield goes down, fell to an 11-month low. 11-month low. Now, both of these inverted in 2000 and 2007, and those then followed recessions. But the full story on this is that even though this is coming down, so as this graph is coming down, that's a tightening. Remember the red line, how it was just flattening out here? We don't want that. We want it to come back and be healthy. And actually, just in the last 4 days, it has come back and been healthy. Healthier, I should say. A lot of attention directed to this flattening, and it's understandable since this spread has predicted every recession since 1980. But here's the anomaly. There have been 5 recessions, according to the NBER, 5. How many has this inversion predicted? It's predicted 9 of them. Yeah, you have to let that sink in. When my wife was proofing this, she said, I think this is wrong. I said, no, it's right. It's predicted 9 of them. So that means there were 4 oops, okay? So you can't make decisions on how you're going to buy for clients' investments on one particular piece of data. And you have to know that aberrations like this happen. Okay, technical influences. This is, you guys have told me over the last 2 years that this is kind of the tough section, but it's important. Politics moves the market, the fundamentals, all that data that I showed you moves the market, but technical, what is actually happening, the actual bars that are trading, okay? I know this looks kind of scary. I always wanted to name a chart after an album by AC/DC, so I did. The death cross in the industry is when the 50-period moving average crosses over the 200-day moving average. So this is the blue line is an average of the last 50 days of prices, and the line underneath, whether it looks mustard or orange, whatever, is over 200. So it's slower. So when the fast one passes over, it's a pretty big deal. So the data says. That doesn't mean that it's going to happen. So now I want to go into some terminology. You hear on the news, pullback, recession, bear market, correction. What's the difference? Well, now you know. So either take notes on it or download this when we're done. A pullback is generally referred to anything that's between 5 and 9.9%. Doesn't follow to the decimal, but that's generally what it is. So that means that anything, I didn't put this in there, between 0 and 4.9 is called a blip. Okay? Just a blip, just a normal market. All right? A correction is more than 10%. Wall Street considers it a correction if it's more than 10%. Now this can be at the individual stock level, the index, commodity, currency, anything can fall into a correction. Okay? Bear market. This is a step up or down from a correction, meaning when prices fall 20% from their recent highs, and I'll always add on a closing basis. So if they do that intraday, that actually happened on December 26th. The S&P 500 traded into bear market territory, and some big guns came in. These weren't mom and pop investors. These were huge hedge funds that came in with tens of billions of dollars to make that move that I showed you earlier from minus 600 to up 260. And you just have to get out of their way. It's like arguing with a metro train. You just get out of their way. Now, take note that certain stocks can be in a bear market. Amazon is in a bear market. It's $400 lower than its high, so yeah. It's over 21% as of yesterday. I don't know what happened today. And there are other stocks, Apple, bear market. But the S&P, no. So they're all jostling around trying to get in sync. You want them all to be in sync. You want nobody to be in a bear market. But sometimes if the indices can hold on, and actually what is an interesting phenomena is that you heard of the FANG stocks. There was a time in August when over 100% of the return in the S&P was from just a handful of stocks, which is scary. And yet some of those stocks that had really bad autumns did not pull the S&P down far enough to bring it into a bear market. So it's interesting how that works. A recession, there's no standard definition. I have mine. But any economic decline lasting more than a few months, I think that's kind of understated, but you'll see it in GDP, real income, industrial production, wholesale, retail. So all the data, the fundamental data that I just showed you, starts getting negative. Did you see any fundamental data that I showed you that was negative? No. We're not there. It begins after the economy reaches its peak, and it ends as it reaches the end of the trough. The end of the trough for the market was March 9th, which I mentioned in the video. That was the lowest price, 676.53, that the S&P has hit in the last 10 years. The economy didn't bottom out until June 19th, I think, of the same year, 2009. We at CB3 define a U.S. recession as 2 consecutive quarters of negative GDP. Not even close. Haven't even had one in years. That's the definition for me. You guys have seen these are my relative rotation graphs. So this collage of indices, these are the various countries around the world, and this is my mea culpa to you all. I see Brazil up there just like you do. I could have bought IWZ in CG. Frankly, I thought that with the political instability and the Brazilian real exchange rate to the US dollar, I thought it was too risky, but it has just blasted into the leading quadrant. For those of you that don't follow my videos or the newsletters, the green quadrant, there's actually some numbers off to the side here, but I'm simplifying it. That's where we want to be. That's the leading quadrant. This space here in the middle is where the world index is, so we want to be better than that. Green means we're better. Yellow means we're better, but we're weakening. This means we're lagging and you don't want to be here. But blue means improving. So what we want to do is buy something in here and have it go into leading and then get out of it before it collapses. So I'm going to zoom in on this chart and just show the U.S. indices. So these are the same ones that are on this chart, but I just removed everybody else. We're still ahead of the world, and I have gone to some cash in the Russell, almost at 20% for those of you that are in the small cap program. But I like this arrow right here. It's turning up, and it's turning up after it just entered the quadrant. So this is just another bit of data that we analyze to see which asset classes we want you guys invested in. That's where we are year to date. That's actually 2 days ago, sorry, and we're higher than that now. So the Russell, which got walloped last year, as you saw, is trying to get back to equilibrium. And that's why it's leading, in my opinion, this year. So after we've looked at the various places in the world where money is moving, we look at the individual sectors. So as I mentioned earlier, there are 11 sectors in the S&P, and there they are. Now, as opposed to last year when I stood here, the risk-on sectors, consumer discretionary, infotech, energy, materials, financials, they were all up here. Now we have the risk-off or the defensive sectors leading the market, and we have rotated your holdings accordingly. Okay? Whenever the risk-off and defensive sectors are winning, that's not good for the economy. That doesn't mean we can't make money. It just means that the utilities are not going to lead us to higher highs in the S&P. They're just not. But if they're making money and paying a dividend, we're interested. Maybe only for a short time, and that's why we're active investors for your accounts. When you see those trades come in, this is what we're watching. We do not want to be down in here. In fact, all the energy holdings but one in small cap are gone and have been. Okay? These are the decisions that we're making on a technical basis for you. Okay, 2019. What can we look for in 2019? How do we prepare for this year? I said when I walked up here after the video, I think this could potentially be one of the most volatile years in the whole bull market. And I think that, why? Because this is aging. If I stand up here again next year, and I hope I'm up here next year, and if the market, I put the if in the wrong place, if the market is still up, we're in 11 years. I mean, it's just totally uncharted territory. So how do you prepare for that? Well, thank you, Santa Claus. You were late. Lump of coal for that, but you at least showed up. And in huge force on December 26th, and then the buyers came in. Okay? FOMO was the reason for that. Anybody know that acronym? That's my favorite acronym from this year. Fear of missing out. FOMO raided the market with big, big dollars, tens of billions of dollars. 2019, thank you, Dan, for this slide. Actually, if you look at all the years of this bull market, 2019 started the strongest. Not bad. Now, that doesn't mean it's going to stay that way. Tuesday was the 10th trading day of the year, up 4.1% after 10 trading days. 2018, in that same, was up 4.6, but it finished down. So a good start to the year doesn't mean it's a perfect indicator. However, look back, going back to 1950, and except for last year, when the year starts strongly, it finishes strongly. So one of two things is in play. Either last year was an aberration, or it was a trajectory changer for a bunch of negative years. For it to be that, I think the fundamentals, that's my previous bullet point, have to be looking uglier than they are. So if I weigh that datum, I have to say that 18, even though it started strong and finished weak, that was an aberration. And today, I'm saying that. I may have to eat these words when I see you in August, but that's where I stand today. So what are we buying when we buy a stock? We're buying earnings. If a stock is going to earn $1 and it's trading at an 18.3 PE ratio, we're paying $18.30 for $1 in earnings. That seems like a lot, doesn't it? But the truth is, there's stocks out there trading at 30 PE and higher. In 2000, it was triple-digit PEs. Again, FOMO, before they knew what the acronym was. So last year, 18.3%, but exiting the year, it stood at 14.2. So if you paid an 18.3 multiple on January 2nd for a stock, you were what? You were losing money at the end of the year, because now it's trading at a 14.2, which is actually a discount to the 10-year average. So you can argue that the entire serious correction, not the little blip that happened in October, November, but the serious correction happened all in the month of December. Highly unusual, big surprise. We're either interested in growth or we're interested in income. So let's look at the income component of this. In 2018, the S&P earnings yield was 5.4%, which is 300 roughly basis points higher than the 10-year. Let's stop and think about this. That means that if I invest in a stock, I'm getting 546, I'm getting 243 in the 10-year, which is actually low now, but roughly that's what it was. If I'm going to give up the appreciation for stocks, I've got to have a little bit more gain than that. If in other words, to move my money to bonds, because I've got no upside in bonds. By the end of the year, the earnings yield was 7.14 or 433 basis points, which means it makes no sense to be in bonds. None. Now, that doesn't mean you shouldn't have any bonds in your portfolio. I'm not saying that, but the preponderance of your portfolio, that's an asset allocation question. Forgive me if I'm stepping on your toes, guys. But for me as a trader, that means that the money is moving back to equities when somebody sees this ratio. And again, on the 26th of December, somebody saw it big time. The earnings so far for the year, pretty strong. We're 85%, even though this is just a few companies, just 27 out of 473. Normally, this number is about 73% beating their projections. So companies will project, well, we think we're going to hit this target. And if they beat it, that's great. If they don't, then they get shellacked the next day in the market. That number has been about 73. Actually, this was 92 just a week ago, dropped down to 85. But in healthcare, industrials, and technology, 100% of the stocks are beating their forecasts. Again, I wish I could come back and show you this in a month and a half. It might change, it will. But this is a good start. It's a good start indeed. So many have characterized this market's rally to be a technical rally from deeply oversold conditions, and that's my opinion. The sell-off on the 24th, when I saw that intensity the day before Christmas, bah humbug aside, on a half day, they were panicking because they knew they only had till noon to get all their sell orders in. Deeply oversold. I think that this market has benefited in the last few weeks from investor sentiment that was lifted by that December jobs report that I just showed you. Do you remember all the bullet points on that? And the assurance from Chairman Powell that the Fed will be patient. You know what the Fed actually does matters hardly anything. It's the language of their statement. Blah, 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 blah. Patient. You're looking for key words. I'm going to go back to 1991. Where's Bob? 1991, James Baker stood up in front of the podium. Totally unrelated, I'm sorry. Forgive me I'm digressing, but this is important. How one word can make a difference. And we were invading Kuwait. And he went blah, 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 and all the traders are just sitting there waiting for the junction or conjunction. And when he said, disappointingly, boom, everybody bought crude oil. So one word in a statement makes all the difference. Crude oil rose $25 within 10 minutes. We haven't had anything that crazy since then, but we haven't invaded anybody either. So at least not that's affected the market. The point is you have to follow what the Fed says. I said earlier, and I'm going to stand by it, I think the Fed will cut in the autumn of this year. I think this raising cycle is going to end. So these developments fostered the acronym that I introduced you to yesterday, just a few minutes ago if you didn't know. FOMO, fear of missing out, drove in those buyers on the 26th and has continued to this day. It's continued to today. That's a big change from October to December when the market was selling. You'd see it gap up in the morning and then you go, yeah, well, by the end of the day, it's going to be down 300. Day after day after day. Okay? Not happening now. I love these covers. It makes my job easy. When I see this, I fade it. New word of the day, fade. When traders fade something, they go against anything that's in the news. So if you hear a trader on the floor saying, yeah, I saw that, I'm going to fade that. So when the doom and gloom is here, and granted, they're kidding, but there's always truth in it. You're fading that. When you see a taxi driver on the front cover that says, I just sold my cab business, I took my $30,000 and I'm investing in day trading and I'm making $14,000 a month from that. That's the time to sell. We still haven't seen that. Let's look at the economies of the world, because this is where the growth is going to happen. I was amazed when I saw this, and I really have respect for this institution. The U.S. and China, if you add up those numbers, if you add up the number 3 through 10 and double it, double number 3 through 10, they barely equal what the U.S. and China are doing. So the conversations, that's why if you wonder why the trade discussions are so huge, and this $3 trillion deficit is so huge, it's because it's the world's two biggest economies and everybody else is just kind of showing up. I don't mean to belittle these countries, but some of them have been around a lot longer than we have. And frankly, I think that GDP is kind of embarrassing. But I digress. These are the big dogs. This is where you're going to see growth play out. So we've been in a bull market, since 2009. And you can see that some countries have been in there even longer. Again, if you don't see this data and you just have recency bias, the tendency to look at what's recently happened, we're getting no help from the international markets right now. It's great to see when the U.S. markets are rising and the international markets. I blew it on Brazil. I fessed up. But the other ones, did you see just kind of circling around there in the mud puddles, in lagging on the relative rotation graph? You got India since 96, Australia since 91. China claims they've been in an expansion since 1989. I think they really believe they've been in an expansion since 3000 BC. They just don't want to face the truth. That's my take on them. Okay, here's my summary. I think we're going to see a rebound in 2019, a rebound from what we just had this last quarter. Strong earnings and economic growth. Interest rates could now be falling. That doesn't mean next month. That means later this year. I think you'll see an interest rate cut. I sure hope I don't have to eat those words when I stand up here in a year. Okay, I think investors will take slightly riskier bets. I think there's been some people burned by this pullback, but this is nothing compared to 2008, 2009, nothing. The risk challenging the U.S., global, will not likely derail the market in the first half. I don't predict the whole year. I'll be back in August, and we'll see if I was right. I do not see anything derailing in this first half. Okay. These are just fun facts for you. Did you know that Uber's just a software tool? They don't own any cars, and yet they're the biggest taxi company in the world. Do you think Yellow Cab saw that coming? These are what are called industry disruptors. Airbnb is the biggest hotel company in the world, and they don't own any properties. Ask Hilton if they saw that coming. Meal delivery services, hottest new venture, people using them like crazy. Ask anyone from McDonald's to the mega grocery chains if they saw that coming. What we're looking for are these kinds of disruptors, except in this case, disruptor is a good thing from the consumer point of view. If you're their competitors, it's definitely disrupting in a negative way, and you either adjust to it or you don't. Remember I said that. I'm going to touch on that again in just a little bit. You either adjust to it or you don't, and if you don't, you die as a company. For us, as consumers, we love disruptors. Disrupt all day long. It makes our lives better. Understanding stop loss. How many of you have been here since 2008? Okay, bunch of you. Whenever the markets go down, I trot this out. I update it a little bit. I think it's been 4 years. If you've seen it before, I'm sorry. Whoops. But it's important. The common question I said in my opening remarks was that people say, well, can't you just sell when things go down and buy when they go back up? Yeah, we can. Doesn't mean it's going to be right. Well, why not? This is why. So let's start with a piece of basic philosophy from Will Rogers. Don't gamble. Take all your savings and buy some good stocks, hold them until they go up, and then sell them. Oh, if they don't go up, don't buy them. Exactly. There should be more laughs than that, but I thought it was hysterical. That actually was said. I'm going to give you 5 scenarios. We're going to walk through. There's many more of this, but I'm going to give you 5 basic scenarios that we in the industry face every day with all our portfolios. You have $100 to invest in ABC stock. Okay, well, the way here. $5 is the maximum you want to risk in the market, so you place a stop order at 95, meaning you're going to get out of the stock at 95. So quick answer. So you buy it at $100 and you say, here's an order. It's going to be what they call a resting order. And I'm going to get out if it trades to 95. Now, the market could gap through that and you could be filled at 94. So this is the disclaimer. You're not promised that you're going to get filled at 95, but you're basically risking $5. You're with me? 5%. So you buy a share of stock for 100. The following week, the stock is selling for 105. The week after, it's selling for 110. It's up. You made $10, a 10% return in 2 weeks. You are a genius. You are happy. Wouldn't it be great if they all worked that way? It sure would make our job easier. In fact, you probably wouldn't even need us. All right? Scenario 2. You have $100 to invest in ABC. $5 is the maximum. You place that stop order. You buy the share at 100. The following week, the market's selling at, a stock is selling at 89. Not good. You just lost $5. Why? Because you had that stop order, so you got out at 95, stock goes to 89 and then drops to 76, and you're kind of cheering for that stock to go to 0. So you wonder why short sellers do what they do. It's because they just get this visceral feeling. Look, you took away my money, you go to 0. I'm going to go to your bankruptcy hearing. People get emotional. Remember, we analyze the analytical, and the artistry side analyzes the emotions. But it's true. You're a genius, you're not happy, but you're satisfied or relieved. If all the scenarios were that easy, there'd be no point in the next one I'm going to show you. You have 100 to invest in ABC, $5 risk again. The market trades down there. You sold your stock at 95. The following week, the stock is selling at 103, and you're not on. And what's settling in? What's that acronym that's settling in your mindset right now, everybody? FOMO. Very good. You have a decision to make. Are you going to wait for the stock price to drop to the original $100 and then rebuy it? Now, if you do that, you're waiting for $3. You're still out $5, but at least you're not out $8 if you wait for it to pull back. Or you could wait till it pulls back to 95. So you have no loss at all, right? So you bought it at 100, you sell it at 95. It goes to 103, it's like, no, you come back. And the stock hears you and goes, okay. and it trades back to 95, bought. So you bought at 95, sold at 95, so you're back in. And then when it's trading at 147, you're banging your head against the wall. Okay? So you're going to rebuy it, in this case, at 103. Then what happens? Now it gets really interesting in scenario 4. So you have that $100, stop order, stop is hit. After trading to 92, ABC now trades at 103. So this is where you got in. You buy it at 103, risking 5 to 98. Notice that I didn't place a stop because, look, the investor says, I've been here. I see this thing go down. It goes right back. I'm not putting a stop in this time. Within 2 weeks, ABC is trading at 97. You're still long. You still own it because you didn't put the stop in because you saw it turn around. It's not going to go down on me twice. You double down. Anybody know what that means? Another bet. We're going to buy $200 worth of ABC to get back to where we were faster. Within 2 weeks, ABC's trading at 78. You've made 3 calls to your cardiologist. Quarterly earnings are tomorrow. Now, you get a little nervous because you look at the history of the quarterly earnings and you see, well, this stock can move anywhere from 10 to 15%, like CRM does, Salesforce, just picking on them. And not only that, you have 31 more stocks in your portfolio with the same kind of decisions to make this week because we're in the highlight of earnings season. How do you feel? Should I just invest in mutual funds and thus buy and hold? Well, you know that I think that buy and hold means buy and hope. So we don't do that. We don't do that for you because we know you worked hard for your money. So scenario number 5, though, is one I don't recommend, but this can happen when people get too much on the right brain side and just get emotional. You've decided that you're sick and tired of this tightrope. You've decided you're sick and tired of your money manager because he or she doesn't know any better. And you're going to diversify and buy just a few stocks and hold them forever and ever and ever and ever and ever and hope. Remember hope? Buy and hope, buy and hold. So it's 1990 and you buy Enron. 2000 and you buy Kodak. We're diversifying. 2001 and you buy Lucent. Probably about like 110. 110, 105 in that year. 2003 you buy Eastern Airlines. Well, you're diversifying. You've got some industrials, you've got some energy, you've got some. 2007 you buy Blockbuster. Now we've got consumer discretionary. We're just buying and holding and holding and holding. 2011 you buy Barrick Gold before their huge explosion killed like 2,000 workers and they went bankrupt. Sorry, I shouldn't have given that away. Today your portfolio is worth less than 10% of what you paid for it. There are no easy answers, folks. What there is a methodology, and that's what we have. That's what OnPath and I have, and that's what we're using for you. Warren Buffett, never lose money, rule number 1. Rule number 2, never forget rule 1. Okay, Warren, what are these drawdowns? Now, he is one of the greatest investors of all time, get it. But when you see this stuff, just like Will Rogers, laugh at it. He has the same challenges. A student came up to Albert Einstein and said, I can't figure this out, I can't figure this out. And Einstein explained it to him. He said, I just have to tell you, as badly as this boggles your mind, it boggles mine even greater. Because Einstein knew what he didn't know. We can't predict the market. My ability to react is far more important than my ability to predict. I don't try to predict the markets. When I give you hints for what could happen in the economy, you don't see me having price targets on any stocks because you can pull your hair out doing that. So how do you avoid surprises? That's what we've been talking about tonight, is surprises. You're our clients. We care about you. We care about your money. How do you avoid surprises? I think it's pretty simple. Those 2 logos. Stick with the team that supported you over the past several years. Read our newsletters, watch the videos, webinars, attend the Fireside Chats. You're here. Go to regular portfolio reviews and keep calm. That's my advice. And a couple people came up at the end, maybe it's 3 or 4, and said, so, Charlie, what do you do to keep calm? Because you're the one we're counting on to make these decisions. And I shared this with my daughter, Meredith, and this was her answer. She sent me this t-shirt for Christmas. Keep calm and compose music. So, if you wonder why there was so much music up front, it's left brain, it's right brain, but sometimes you just have to get away from all the math and analytics and the hysteria surrounding that. Go away and do something creative, and then bring that back to the decision-making process to set what we're doing apart from the crowd. Okay? All right. Thank you guys for hanging in there. That was a long hour.